Hey, welcome to Money Club Mondays. This is November 28th, 2022. And today we are going to talk about the ABCs of private money lending. So for everybody that's on here right now, I would definitely start with, if you're just getting into private lending and want to know best practices and what to expect, we're going to talk about that right now today. And we're going to talk about some real experiences because, we have some lenders that are on watching right now that have been lending in the Private Money Club that before they started doing this, they were brand new. They'd never lent money before. So I want to hear some of their feedback in the comments. And if you have any questions, let's make sure you ask those questions and we'll cover those here today live as we get going. But this book right here, the Private Money Guide, we can send you a digital copy of that book free of charge. So just let me know if you don't already have that. But that's a great place to kind of walk through what private money lending looks like and how that's going to look. We're going to get into that today. All right. So the ABCs of private money. So first off, what is private money? So private money is money that an individual has. So someone like myself, someone like Tess, like Michael, like Mary, like George, just reading the names in the chat box. So just people that want to be able to lend money on real estate deals without actively being involved with them. If you were watching the introduction just now, and if you want to learn more about this, just, I put the link in the chat box there, but we were talking about different types of money and where your money's located. So, we talked about a savings account, an infinite banking whole life policy, maybe a line of credit, maybe like a 401k or an IRA. So these are all places where money is warehoused, where it's stored, where it's kept under a mattress, things of that nature. And some of those, maybe are smart to do, a smiley face, so to say. And some of those might be, a frowny face because, why are you doing it? Things like a savings account. A savings account, there's no interest being paid on money sitting in a savings account. And with inflation running as hot as it is, money sitting in there is basically losing money by being in that savings account. So saving money should be a positive for your financial future. You shouldn't be losing money with money sitting in a savings account like that. So, there might be better places like putting in a specially designed and engineered whole life policy like we do with the money multiplier and the infinite banking concept, where you take advantage of the uninterrupted compounding interest that you get inside of there, as opposed to, again, just a traditional savings account. So we won't get too much into that, but just know there's multiple places where your money resides, whether it's in a qualified account like a self-directed IRA or it's just cash. This is private money, though. This is money that we have available to us that we can deploy out to make more money. Once you understand where your money is located, one of our goals is to have our money always out there making more money for us. So what does that mean? Right? So let's say I get a paycheck, inheritance, side business. Where else does money come from typically? Other pensions, maybe whatever, right? So this is all income. Now, some of that income might flow into qualified funds. Some of it might flow into those specially designed whole life. Some of them might flow into savings, wherever it goes, right? But that's all income that's coming in. And then it goes to these different various places and then you deploy it. So once it's in those places though, then that's why we can look at what are we doing with it, right? So if it's in like an IRA, for example, then you need to invest. If it's in a savings account, then maybe the money just sits there. Maybe you're not investing. So in a savings, maybe instead of a bank, maybe it's an IBC policy. Again, we just want to maximize what we're doing with our money. And if it's a line of credit, like a HELOC or something like that, then that's just leveraging a line of credit and making what's called a spread. So like a LOC, so like whether it's a HELOC or any kind of line of credit, if you're paying 7% and you're making 15%, you make an 8% spread, right? So that's just leveraging money that you have. So line of credit's a little different than income, but it's still money, right? So when it comes to this income, then what do we do with that income? Well, the money can flow into things like, again, like an IRA to invest, a savings to do that, expenses. So things, this is all stuff that our money goes to. And so when you do like the infinite banking concept, we can look at running our money through a policy and then paying off bills and expenses. So that way, like when we do the presentation, we build the dollar bill backwards. What if it looks like if we pay ourselves first, if we save first, and then the money goes to everybody else? So there's ways we can be smart about that. But what we're going to talk about today is not expenses or bills. It's not savings or what your budget should look like. We're going to talk about investing. So all this money that we have access to and that we have coming in and that we've saved and that we've done all this stuff with, whatever is not going to expenses and savings and all that other stuff, that's what we want to look at being smart with our money, okay? So that's where we want to look at investing. And there are lots and lots and lots and lots and lots of ways to invest. Everything from the stock market. And within the stock market, you have all kinds of different ways you can invest, whether it's options trading or shorting stocks or going long on them, or even buying like bonds. And there's so many different ways to invest in the stock market. All right. So I'm not going to get into all that right now. And then even within those different types of ways to invest, you have a lot of different options. So you have small cap and large cap and tech stocks and mutual funds, which are basically a bowl full of a bunch of different stocks all together to diversify. So it's all these different ways of investing, right, through the stock market. And then what else can you invest in? Businesses, startups, things like when you watch Shark Tank, angel investing and all these different types of business investing that you can do. You can invest in real estate, where you can actively go out there and buy and sell real estate. And, you see a home and you see it's kind of worn down and you say, hey, I can buy this house low. I can put some money into it to drive the value up. And then I can sell it up here at market value. And you make, whatever that profit is. So there's ways to do that. You can buy and sell cars. You can buy precious metals. I mean, there's so many different types of ways in investing. So if you want to learn just about investing and all these different options of how to do this, that's where our money school training comes in. We call it Money School Essentials. And that's where we spend 3 full days just going into all of that stuff. We bring on experts and we really dive into it. So if you just want to learn more about investing in general, this is where you want to go. Or remind me at the end and I'll put it up. We just did a Black Friday sale where we sold the last class that we did for like 90% off. So you can get the recordings and watch that. So I'll put that in the chat box in a second. But that's investing. All right. And then within the, all these different options, the reason we're all here today is for the Private Money Club. So the Private Money Club is a very specific type of investing that can be done. So the Private Money Club is a community of 2 different types of people. So the Private Money Club has lenders and it has borrowers. Depending on the type of investing that you're doing, it's going to basically dictate what side of that coin that you're on within the Private Money Club. But that's all that's in there, okay? So all of this, so the Private Money Club, what is the Private Money Club? Real estate. Real estate, just like stock investing, is a humongous broad range when it comes to different ways to invest in real estate and types of real estate. So when it comes to real estate, you have single family homes. You have where and within single family homes, you can buy and sell them. You can do what's called wholesaling, which means you put it under contract and you sell the paper to another investor before you even close on the house. You can do full rehab projects. You can do what's called wholetailing, which means you put a house under contract. It doesn't need a lot of work and you actually do close on it. And then you spend just a couple weeks painting the walls and just doing some small little minor rehab and then immediately resell that thing. So it's kind of like a combination of a wholesale deal, but you do close on it. So that's called wholetailing. And then once you own the property, once you buy it, if you don't flip it, there's all kinds of different exit strategies between long-term rentals or short-term rentals like Airbnbs. You can do lease options. You can do seller financing. You can sell the note to the property. So there's all these different exit strategies for single family homes. There's different ways to buy them, whether it's through foreclosures, whether it's through seller financing, creative financing, sub 2 like Pace Morby teaches, all these different types of ways to acquire properties. So this is all stuff within real estate, different sections that you can make money. That's just single family homes. And then you get into house hacking, where you buy a house, you live in half of it like a duplex or a triplex, and you rent out the other parts of it, or you rent out rooms. And then you have multifamily. So 5 units and above is considered commercial multifamily. So now we're looking at like apartment complexes and townhouse complexes and all these different types of, different types of real estate properties. And then you have land, you have raw land, you have land development, you have mobile home parks, you have storage units, you have RV parks, you have all these different types of real estate, all these different types of ways to making money in it. But at the end of the day, it really boils down to only 2 different options. And those 2 different options within real estate are active and passive. Typically speaking, if you're joining the private money club as a lender, do you want to be an active or a passive real estate investor? Passive, right? Because if you're a lender, that means you have money. And when you have money, you're looking to lend money to make more money. So that would be more passive investing. Over here on the borrower side, what do borrowers need? They need money. Why do they need money? Because they want to actively go out there and do one of the strategies that I just mentioned when it comes to real estate investing. They are either doing flipping, or they're doing Airbnbs, or they're doing lease options, or they're doing apartment complexes or land development, or one of those things that I just talked about is what the borrower is doing. Okay, so they need the money so they can actively go out there and do those deals. So that's what active and passive means. And that's typically, now, can somebody be both a lender and a borrower? Absolutely. But typically when you come in and get started, you're going to kind of have a goal in mind of why you're joining. And it's usually going to be one or the other. Okay. Now, if you're you're doing both, great. No problem with that. You're more than welcome to do all the lending and all the borrowing you ever want to do. But I'm just saying, this is typically what it looks like inside of here. When it comes to these different types of deals, let me also make this very specific, because again, tons of different real estate deals, active and passive, will still be true, but there's different types of real estate deals that can be done when it comes to lending and borrowing. So just to give you a quick example, syndications, private funds, direct lending. So these are going to be the three types of deals that borrowers and lenders can put together to make this happen. Syndications. In syndications, there's two different types of people. There's a general partner and there's a limited partner. The general partner is going to be basically like the borrower in a syndication, because the syndication combines the borrowers and lenders, essentially the active and the passive investors. It combines them together. Now, general partners will often have their own money in the deal, but general partners are going to be the active investor in a syndication. So they're the ones in charge of the syndication, of making decisions, of doing the work, of putting everything together, of making sure everyone gets paid and everything. So that's what the general partners in a syndication do. Limited partners in a syndication are the lenders or the passive investors in our private money club scenario here. So the limited partners, they put in their money into the deal and then they sit back and they wait. And then depending on how the syndication is structured, they might get monthly interest payments. They might get paid all at the end. They might, be in the deal for the long term. Once it's refinanced and they get a certain amount of profit. So the syndications can be structured differently. But at the end of the day, you have the active general partners and the passive limited partners that are in the deal. Private Money Club is not for syndications right now. We are not doing syndications in Private Money Club currently. All right. So number two, private funds. Private funds, what this is, it's similar to direct lending, but it gives the borrower a lot more ability to do other things. So in a private fund, there's going to be a fund of money. The passive investors are going to lend to the fund. So the passive investors lend to the fund. The money goes into this big pool of funds. So all the investor money from multiple investors is inside this fund. And then the fund invests in various deals. So let's say the fund invests in a house flip, and then the fund invests in, some land. And then this fund invests in some RVs. We'll draw some RVs on there, an RV park or whatever. So the fund can invest in whatever it deems necessary for the fund to make money within the parameters of how the fund was designed, which is typically for real estate transactions. So that's what a private fund is. And the managers of the fund, the owners of the fund, they have complete control in what that fund is doing. So to give you a couple examples of that right now, I have a fund with Chris Noggle and Greg Hurleen and Kent Clothier called the Inicio Fund. And this fund that I'm an owner and partner in gets investor money. And we identify and locate deals that we want to lend on or purchase the notes on and be part of. And then we make the money and then we pay the profits to the investors. So we manage it all. And so it's a very passive investment. Now, Private Money Club is not for private funds right now. We want to keep Private Money Club very simple. So Private Money Club is not for businesses. It's not for these other types of investments I mentioned earlier. Private Money Club is not for syndications that can get complicated. It's not for private funds. Private Money Club is for one type of lending only, and that is direct private lending. Direct lending. So what is direct lending? And again, we're doing this by design. We want to make this simple. So when someone comes as a private investor, as a private lender in a private money club, they're not overwhelmed with all of these different options and ways to invest. And you can get there. Once you learn private lending, you're going to start learning about syndications. You're going to start learning about private funds. Why? Because now you're part of a community and a network. And this is what we talk about all day, every day with each other. So if I'm talking to Chris Nagy, or I'm talking to Chris Bizup, or I'm talking to Chris Rude, a lot of Chris's involved, right? With the private money or whoever, right? Justin Colby, you're going to hear us talking about these different types of deals because Chris Bizup does a lot of syndications, but he also does a lot of borrowing on private money club. Justin Colby does a lot of private funds, but he also does a lot of private borrowing. And that's at the end of the day, what private money club is not only direct lending, but it's a community and a network where we can all work together to learn all this stuff and help each other out in making more money with this. When it comes to the lending side of private money club, we're keeping it very simple. So when you go to the site, you're going to see one type of deal and one type of deal only, and that's direct lending. And that's a good thing. So let me show you why. This is going to give you the most control. And remember, one of the reasons we're doing this is for control, right? Controlling our money. Direct lending gives you the most control. And I'll show you why in a second. So who does direct lending? Who does the most direct lending out there? Okay, so this goes back to what we do every day. See it up here on the side, right? BYOB. So this is what banks do, guys. Direct lending. Mortgages. Mortgages basically are direct lending. That's it. Banks will give you a mortgage. So will I. Okay, so will any of the lenders that are in the private money club. So what is direct lending? Direct lending is doing exactly like the banks do in funding someone's deal. We go back to borrowers and lenders. So the borrower needs the money, right? The borrower needs the money to do the deal, and the lender has the money to be able to provide that for that deal. What does that look like? Let's hop on Private Money Club real fast and take a look at this. So this is Private Money Club. So let's say, all right, so I'm a lender and I'm looking for a deal here. So browse deals, go to deals, and it has some of the deals that pop up here, all right? So let's just see. All right, so I know Taylor works with Chris Rude and does all his deals. All right, so let's take a look at this thing. All right, so this is, we're just going to write Taylor so we remember which deal it is. And Taylor needs $315,000. Now, if I'm Taylor, what are my options for getting funding for this deal that I want to do? I could go to a bank and I can apply for that mortgage, for that loan, for that property. So this property is in a great area in New Orleans. Seller moved into the house in 2017 and completely updated most of the house. The showers are still old. I will do minor touch-up work, then rent this place out and refinance it. So Taylor's doing what's known as the BRRRR method as his exit strategy. So he's buying it, he's putting a little bit of money into it, he's renting it, and then he's refinancing it. Whenever he refinances it, he will repay the lender, and then he'll have that property long-term as a rental property. So that's his exit strategy on this deal. Cool looking house, yada, yada. No big deal. All right. So a couple things on this. So he's showing here, he's $315,000 is the investment. The purchase price, I would assume, is $300,000. Just want to double check all this. So this gets into underwriting, right? So if I go to the bank to apply for a mortgage, for a loan to buy this property, the bank's gonna have me fill out a bunch of documents. Taylor's gonna have to provide the bank what the house, the comps on the house, or the bank's going to look into that themselves, but they're going to want to know what the house is worth through an appraisal. So comps and appraisals are similar. Maybe you would request it, so the bank is going to want an appraisal done though, so they know the value of the house. They're going to want to know Taylor's, worthiness. So his credit, what all that looks like. Can he pay for this thing? All that stuff. So at the end of the day, what are they really doing? They're underwriting the deal. So underwriting is simply verifying that lending money, giving money to that person is a smart idea, basically. So when we underwrite a deal, what are some things that you would want to know about? So if you were saying, hey, Taylor, I know you need $315,000, whether you're a banker working for Chase Banks or whether you own your own bank and you're looking at doing this loan yourself. What are some things you'd want to ask Taylor? So maybe you'd want to ask for a PFS, which is a personal financial statement. What is a personal financial statement? It basically shows me what Taylor is worth. his net worth. So what income does he have? What expenses does he have? What assets does he own? What kind of leverage does he have on those assets? What's his debt to income ratio? So this is all stuff that I want to know about Taylor. So that way I know if I lend him money and something goes wrong with that deal, can he still pay me back? Some borrowers on Private Money Club will say the personal financial statement doesn't matter because when you lend me money, it's a non-recourse loan. All right, so let me explain this. So a non-recourse loans means property only, recourse personal. So recourse is a personal guarantee, essentially. Non-recourse means your only recourse is the property. So let's say this is the house. That's the house that I lend money on to Taylor. Taylor's midway through the deal and Taylor disappears or something happens and Taylor can no longer fulfill the obligations of that mortgage. He stops paying you or whatever happens. Something happens with the deal where you're not going to get your money back anymore. In a recourse loan, you can, depending on the wording of the mortgage and the contract, typically you can foreclose on this property and take the property over where you now own it. So then you can take that thing and you could sell it, or maybe you auction it off or whatever. You can do that. And let's say that you lent them $315,000, but this thing only sold at auction for $200K. You're short $115,000 of getting your money back because you lent $315,000, but the house only sold on auction for $200,000 that you got back. So you're still short $115,000. Well, if you have recourse, you can go after Taylor personally. So if he owns other real estate or whatever, you can put a lien on that stuff a lot of times, or you can go after him personally or whatever. You can go after him to recoup the remaining amount of that money that's still owed to you. Non-recourse means your only recourse is that property. So if it sells for $200,000, you're out that $115,000. You have no other recourse to go after anything else that Taylor or his companies or anything like that have done. So just keep that in mind when you're kind of looking at some of these different mortgages and contracts. Now, when you're looking at banks, what banks do, banks will almost always have the ability to go after you personally as well. One of the times when you'll see a bank do a mortgage that's non-recourse is in a self-directed IRA loan. So if you use a self-directed IRA to get a loan as a down payment for a loan from a traditional bank to do a real estate transaction, for example, self-directed IRAs are a protected asset class, I guess you could say, but they're protected from judgments and lawsuits and liens and encumbrances and things like that. So the bank lending money to a self-directed IRA to purchase a property, they cannot have recourse because by law, that IRA is non-recourse. So a bank will do a non-recourse loan to a self-directed IRA often. But that's typically one of the only times you'll see a bank doing that type of loan. Chris Noggle, you'll hear him talk about this. He only does these with personal guarantees. He will not touch it if it's not personally guaranteed or by someone else. But everyone's different. And then you look at, okay, well, what's the risk? You know, if it's this kind of loan, but they only need $100,000 and the house is worth $500,000, yeah, who cares? You know, because odds are, if I have to sell that thing, I'm gonna end up making money anyways, or I can take possession and do something. So right there, that might make sense. But if the numbers are tighter, then maybe I want to increase the amount that I'm lending. So instead of 12%, maybe I say I'll do it for 16%. So instead of 12, I do it for 16. Why? Because of the added risk that this might bring on. So what else would the bank need? When it comes to the underwriting for the mortgage that we're going to put on this property, so again, the personal financial statement. So that'll tell us a lot about the individual and whether or not we're willing to lend to them. What else would you want to know about this? Well, you want to know about the house, right? I should say the property. So it could be land or something, right? So you want to know about the property. So what's it worth? So we want to know what the value is today. And we also want to know what the value is after the property is fixed up or whatever that borrower plans on doing with it. So that's what's called after, also known as ARV. You'll hear that a lot of times. So value today as well as value after the rehabs are done. And keep in mind right now in this market we're in, where we see a lot of downturns and prices starting to pull back, you want to make sure that they are building that trend wherever the property is located into their after repair values. Because if the house is worth 200 grand today, or if the after rehab's worth 200,000 today, but we're in a declining market, maybe that thing will really only be worth 180K in 6 months from now after all the rehab and repair work has been done. So make sure you're keeping that into account as well. All right, so that's stuff that we're going to want to know about. So how do we find that out? Well, we find that out through comps, also known as CMAs. So comps are comparable market analysis. This is where we take the subject property and then we find other properties in the neighborhood or real close by that are similar. So if this is 3-bedroom, 2-bath, 2-car garage, we want to look at other properties with 3-bedroom, 2-bath, 2-car garage. Or if this one has a swimming pool, or if this one is on 2 acres of land, or whatever, we want to compare it to other similar properties. Age. Was it built in 1990? Well, let's find other ones that were built in the similar age range. And that'll start to give us what it's worth. Are we comparing it to houses that are fixed up? Or are we comparing it to houses that are also in disarray that need fixed up? So that can help us start looking at the value or the after repair value for that property. Or if you really want to know what it's worth today, you do an appraisal. So the appraisal will tell us what it's worth today. And then we can look at the comps to tell us what it'll be worth after the rehab. So that way we're kind of finding out everything. So we're underwriting this deal though at the end of the day. We're underwriting the investor or the borrower, and we're underwriting the property itself. Those two things. For me, I like to start with the individual first, because if I have a relationship built with that individual and I've lent money to them in the past, or they have a bunch of good references, or I know other people that have worked with them for a long time and they're very happy with that relationship, well, it gives me a little bit of a good feeling moving into underwriting the deal, that I can kind of trust some of the stuff that's being said. Otherwise, I want to verify everything. All right. So then once I check, okay, I like the individual. Okay, I look at the deal. I like the value of it today, my loan to value. I like my loan to value after the rehab work is done. I like the exit strategy that the borrower is doing. I agree with it. I think it's going to be good. And they have alternative exit strategies in case something does go wrong. I have a personal guarantee on this thing. All right, now I like the person. I like the deal. Then what's next? Well, now we got to figure out the terms of the deal and make sure I'm okay with the terms of the deal. So that'd be like the lending amount. So how much am I lending to them? And that's going to go into making sure that the value's there, right? The loan to value, interest rate and or points involved on the deal. So this is how I make money lending on the deal. So how much I'm lending and how I actually make money on it. So the interest rate, for example, 12% annual, let's say I have 2 points. Points are simply 1 point is 1% of the total lending amount, no matter how long the deal is done for. So $100,000, 1 point of $100,000 is $1,000. So it'd just be like an extra $1,000 that I get that the borrower pays me for lending on that deal. Or 2 points would be an extra $2,000 per 100 grand that I lend to them off the bat, whether they borrow the money for a month, whether they borrow the money for 5 years. The points are done one time. They can be paid on the front end, on the back end, during, whatever, but it's extra money that the borrower is paying me to lend them money. So the interest rate and the points are what typically make up what you're going to make on the deal. How is that paid? And the how paid has 2 different parts, interest and points, and then 2, principal. In most lending deals, what's very, very common is you lend the money, then it's interest only monthly payments. Frequently, you'll see quarterly payments as well, but very oftentimes monthly interest payments. And then the principal, when do you get the principal back? Typically speaking, the principal gets returned to you when the entire thing is closed out at the end. So once the deal is completely said and done, and the borrower closes it out on their side, whether they sell it, whether they refinance it, whatever they do to exit that property and get that principal money back, then that's typically when it's returned to you. And in the contract, the mortgage, remember the mortgage and the promissory note, those are the 2 things that make up the overall contract that state all of this stuff. So in the promissory note, it's gonna tell you what that looks like and how long that is. So the length oftentimes will be like 12 months with a possible optional extension for another 12 months with no prepayment penalties, right? So let me show you exactly what that would look like in reality here. make my math easier. I'm just going to say we're lending $100,000 here just to make the math easy. Starting from first scratch, I go to Private Money Club. I find a deal posted by Taylor. I know Taylor, and he needs $100,000 for this deal. Okay. So I go through my checklist of underwriting. So I underwrite Taylor. Okay. Then I take a look at the house. The appraisal's good. To the value, the loan to value is good. So I'm lending $100,000, but the house is worth $200,000. After rehab, it's going to be worth $250,000, right? Or whatever. So it's a very low loan to value. That's like a 40%, 30% loan to value. So that's very, very good. So I'm good with the lender or the borrower. I'm good with the deal itself. Everything checks out. Okay. And now I want to make sure that I'm good with the contract. Again, the contract's made up of the mortgage or deed of trust, depending on what state you're in. And it's also made up of the promissory note. So the mortgage and the deed of trust, so the promissory note is connected to the mortgage and deed of trust as a part of the contract. The mortgage stipulates what happens, in the case of, lack of payment or whatever that looks like. And the promissory note's going to have all these terms in there that state how much is being lent, how much is being paid, and all that stuff. Okay. So in this PN, again, we have over here. So in this case, we're lending $100,000, 12%, let's say 2 points. Number 3, so interest only monthly, points up front, and principal at end. Principal at end, just to give you an idea. Number 4, it's a 12-month contract, no prepayment penalty. So in this promissory note, it's going to say, okay, I'm lending $100,000, 12% annual, 2 points. Interest only, monthly payments. Points are paid up front to me. The principal comes to me at the end, and it's a 12-month contract, and there's no prepayment penalty. What does this actually mean to you as the lender? What do you get out of this? So the borrower, Taylor, gets your $100,000 to go do the work on this house. And then what do you get? The $100K, just to be clear here, does not go to Taylor, okay? The $100K is going to go to the escrow company or attorney. So you wire the money to the escrow company or the attorney, then they're going to check the mortgage, promissory note, the paperwork, the contract, make sure everything's in place. If it is, they're going to sign off on everything, the deal closes, and then they release the money to Taylor's company. So also, you're never going to lend to an individual. You're going to lend to the LLC or the company. Just remember that, okay? So the $100K goes to escrow, and then the escrow company releases it to Taylor's LLC. Okay, so now Taylor has the money to go do the work. As soon as that happens, then the terms of the promissory note just start to kick in, which means, so as soon as this happens, Taylor gets the $100,000, I get $2,000 immediately. Why would I get $2,000 immediately? 2 points up front. So as soon as this contract is executed, they're going to send me $2,000 because I got 2 points on the $100,000 loan right off the top. I'm going to start getting every 30 days or every month, let's say on the first of the month to keep it easy here, I'm going to get 1 percentage point. 12% annual divided by 12 months is 1% a month. 1% of $100,000 is $1,000. So now I have $1,000 per month coming in. And that's going to continue to come for month 1, month 2, month 3. And all of a sudden, month 4, Taylor gets the house done and gets it sold. Okay, that happens. You're going to get back now your $100,000 returned. There is no prepayment penalty. So it was a 12-month contract. He paid it off in 4 months, but that's okay. We're good. So we got our $100,000 back. So what did we just do at the end of the day? Well, we lent $100,000 out. And in 4 months, we made $6,000. $6K in 4 months on our $100,000. And then what are we going to do? We're going to say, hey, Taylor, that was awesome. Let's do it again. Or we're going to go right back on a Private Money Club and we're going to find our next deal. And we're going to do it over and over and over again. That's direct private lending. That's pretty much what's involved. That's pretty much what the process is going to look like. Obviously there's some more little things in there, like some more questions maybe to ask the borrower and clarification on, in the promissory note and the contract, we want to make sure that, for example, we're listed as the lender as what's called additional insured. So if something does happen with that property, it burns down or something, we get paid our money. It doesn't all get paid directly to the borrower. They can run, because then if you foreclose on a burned down house, what are you really going to get? So you want to be listed as additional insureds, little things like that. But a lot of those little details are covered in the private money guide. So make sure you guys either have the digital copy we send you for free, or you can buy this right on Amazon, and it's also available on Audible. I believe it's free on Audible if you have those credits or whatever. There's lots of ways to check this out, but definitely rely on the private money guide for a lot of the little fine details, because this is what it's all about right here. It creates those win-win situations. A win for the lender, because I can make money while I sleep, essentially, and a win for the borrower, because they can get money quick, easy, money they otherwise might not qualify for, and they can do more and more deals so they can make more and more money as well. So do they pay points out of loan proceeds? So they can pay the points however they want, Morgan. That's up to them. Once you lend them the money, they're basically using that money however they want. So if they paid out of that, that's up to them. Yeah, so an amortized loan looks a little bit different. So that's a great question, actually. Let's cover amortized, and we'll end with that. So again, this is what most private lending deals look like, with the interest only payments, and just because it makes it the most easy for everybody involved. But I can show you what an amortized loan would look like as well. So the amortized loan is typically going to be for longer term deals, because it's going to take time for the interest to be paid. So let's just say $100,000, same, we'll do 100,000. Just say, I guess there's no down payment. So let's say it's 30 years. Is that all right? Maybe 10 years, looks like 20 years. So let's say it's 20 years amortized. No, let's say you amortize it at 12%, whatever zip code you guys want to use. So we didn't include any property tax or homeowners insurance in the last one. So we went in this one. That's kind of a different cost that goes into it. That's part of the borrower side of things there. So if we're just looking at this right here, $100,000 at 12% amortized is $1,100 a month. So right off the bat, you can see they're paying back. The borrower would be paying you back a little bit more. So simple interest, we were at $1,000 a month. This is at $1,101 a month, so about 10% higher. And then if we look at the amortization, principal paid right there, the interest paid right there, and then the loan balance, how it goes down over time. So you can see that it's instead of a level 12% for the entire thing, the beginning, there's more interest involved in an amortized loan and less interest towards the end, as opposed to just level the entire time. So it's not common at all to do an amortized loan for these kinds of direct lending, unless it's like a long-term project, like 5 years, maybe even longer, where somebody's doing like some kind of creative financing maybe, or, there's different ways, but you're not going to see a lot of amortized loans in Private Money Club, I'll say that. But if you did and you wanted to kind of play around with it, you could just come to bankrate.com, go to this mortgage calculator, it breaks it all down for you. You can look around on it. So it just shows you your principal interest. So, you pay $1,000 in interest, and $998, and $996, and $994, because you're paying a little bit in principal each month. So it's reducing the loan balance. So to me as a lender, I'd rather just get $1,000 a month while I'm using the money, or while they're using my money, and they get my principal back at the end. But nonetheless, that's what it looks like. George said, do they always pay points or just interest? So that's up to you. It's all negotiable. It's whatever the borrower is willing to pay and whatever the lender is willing to lend. So if I have a deal, let's say I need $100,000. So they're all looking at this deal. So Morgan's like, that looks good. That looks good. That looks good. Ask 12% annual, no points. So you guys are all looking at this deal. And then I'm like, and then Morgan calls me and is like, hey, I'll do it. But I want 15%. And then George says, I'll do it, but I want 12% and 2 points. And then Tess says, you know what, Stephen, I really like you. I've worked with you before. I'll do it for your 12%, no points. And me as a lender, I'm going to say, all right, all things else the same, or me as the borrower, I'm going to say all things else the same. I'm going to pick Tess. She's willing to do it at 12% with no points. But let's say Tess didn't exist and I have a closing 2 weeks. That closing's coming up quick. I need that money now to get all the paperwork in place so that thing can close in 2 weeks and I don't lose that deal. Because if I can do this deal, I'm going to make $200,000 profit. So it's a killer deal. I'm going to make a ton of money, but I got to get that money. So I look at this and I'm like, all right, these are my only options. I know I would rather just pay 12% with no points, but I got to get the deal done so I can make my money. I'm willing to do it for 12% plus the 2 points George wants. Or let me do the math. It's only going to take me 6 months. Morgan doesn't want any points, but he wants a higher annual rate, simple interest. So I'll do the math. Which one makes more sense? Morgan makes more sense. All right. Morgan, all those things the same. Morgan wins. Or I go back and I say, George, you know what? I'll do it, but let's split the difference. I'll do it at 12% for 1 point. Negotiate. It's all a negotiation. One borrower wanted to do equity. So that what we've talked to up to this point are just interest and points. So interest. So how much you're making off of the money that you lend. It's a very easy, simple calculation. Again, I know if I lend $100,000, that's $1,000 a month coming in. I know what the points are. Very straight and easy. I get my money back at the end of the deal, whatever. That's it. It's a transaction. Equity. So we do this deal, borrow $100,000, we make a $200,000 profit. That might be a little unrealistic. Let's just say we make a $100,000 profit. So at the end of the day, they have a total of $100,000 in this thing, and they just sold it for $222,000. And after all the fees and costs and realtor commissions and closing costs and attorney fees and everything are out of the window, we made a $100,000 profit. So let's say they put you on for 10% equity. Well, that $100,000 profit, you just made $10,000. 10% of 100 grand of the profit. But this also can be defined in the promissory note. So I've also seen where they can share in the profits. It's more gross. So if they make 100 grand, they're going to pay you the equity out of that even before like realtor fees and things like that come out of it. So, but that's all that typically means when it comes to the equity is you're sharing in the profits on the deal. Or if it's a long-term, sometimes you'll see this. This is actually one that you might see also. So maybe you see this. Maybe it's a longer-term deal, and their exit strategy is to keep it as a rental property, or they're going to lease option it, or they're going to refi it and turn it into a short-term rental or something like that. Well, you lend them $100,000 at, let's say, 10% annual interest, for let's say a year. So you have that simple interest coming in all throughout the year, each month. And then once the property's refinanced, then they're going to cash you out that principal loan. And then from there, instead of just cashing you out and the deal is done, you remain on the deal, getting, let's say, 10% equity, 10% net profit of whatever the deal does moving forward after that. So not 10% of the loan amount, but now you're on for 10% of the net profit of whatever that deal does moving forward. So it could be something like that even, as far as like on the equity side. So those can be set up differently also. But then that gives you, money now on your money, but then also long-term money coming in, not with your money, just for being part of the deal, right? All right, thanks, guys. Well, hope everyone has a great week. We have a lot going on this week, lots of good webinars, and we're going to be wide open for the next several weeks right up until Christmas break. Then probably have a little lull, and then we have some really, really, really awesome stuff planned for 2023 and going into the new year. So I hope everybody, again, had a great Thanksgiving weekend and off to a strong start on this Monday. If you need anything at all from me, give me a shout. I'll be here. Hope you guys are doing great. Thank you so much.